Good morning and welcome to the Miller-Johnson Coronavirus COVID-19 Response Team Morning Seminar. This is Laurie Murphy. I'm the chair of our private client and estate planning group. I'm here with my partner Raj Malviya, and we are talking today about strategic estate planning in a COVID-19 market. What we have come to find out is that this is our new normal, and this is a new normal that is going to continue for a period of time. And so we have been starting to hear from our clients wondering, are there any ways that we could be making lemonade out of lemons? Are there any good things for planning that can come through this very difficult time? Next slide. As we're looking at the challenges that we're facing, obviously the pandemic has touched each and every aspect of our lives. It's touched personal and family health and safety. It's interrupted almost all of our businesses and particularly had an impact on our closely held businesses. The future of the economy is uncertain, and most of our clients are facing depressed asset values, and that's really across every aspect of asset values: real estate, personal property, marketable securities, closely held business assets, debt instruments. All of those things have gone down in value, and that presents huge challenges in a variety of ways. Next slide. But as we look forward, we really are optimistic that we will see a recovery, and it's not going to be tomorrow, but we do feel like most of our clients will recover in a matter of time. So this does present some opportunities in the estate planning and transfer tax world, particularly for clients with significant net worth, with family businesses that they hope to transition, and with people who are trying to minimize their exposure to transfer taxes. So those opportunities are really in three specific areas. The first area is we are at historical highs in our federal estate tax, gift tax, and generation skipping tax exemptions, and those are likely to continue for at least a few more years. We have historically low interest rates, dramatically low interest rates, and those low interest rates are allowing some specific leveraging that has never been available in the past. And last but not least, as mentioned above, these depressed market values may allow us to make gifts on a more leveraged basis, because when you give away the asset, the value for transfer tax purposes is the value at the time of the gift. Raj, could you talk about the estate and gift tax exemptions and how that's affecting us at this point?
Sure. Thank you, Laurie, and thanks for leaving me with the fun topic to start our morning off with at 8 a.m. I hope everyone has a cup of coffee in their hand. I'm on my second cup. You know, just to add a little bit more color to what Laurie was talking about, this is really a lot of the foundation for what private client lawyers like me and Laurie are looking at when we're trying to assess whether a transfer intra-family to loved ones, trying to transfer a business interest down to the next generation, and various other types of scenarios make sense. We know there are a lot of implications when transferring value. One of those is what are going to be the tax implications, and we're laser focused on our federal transfer tax rules, being the gift tax, the estate tax, and the generation skipping transfer tax. Now, we know that these taxes are going to be in play for a while, because historically, the transfer tax system, particularly the estate tax, or what many call it or dub it the death tax, has been around for over 100 years, and over time, our government has given us as taxpayers exemptions to having to pay this death tax upon our passing. And along with that, our transfers during lifetime. And these exemptions, I like to call them tokens, or a token allotment, used to be really, really low. Think back to the 90s these exemptions were as low as 600,000, 650,000, and you can do a Google search and find a chart that historically shows what the estate tax and gift tax exemption has been over time. And as time went on, we came into the Bush administration. The exemptions started to go up around 1 million, then 2 million, 3 million. The Obama administration brought it up to 5 million per person. And now under the Trump administration, under the Tax Cuts and Jobs Act, which was passed a few years ago, the exemption was effectively doubled to 10 million per person. And these are for U.S. persons, so think U.S. citizens and residents. And that figure we have on slide 6 here is the inflation-adjusted figure for our exemption or tokens. So 11.58 is the exemption for estate and gift tax transfers for this year, 2020, and how the law was written is that this exemption, this 10 million with inflation, stays in effect through the end of 2025, at which point it then reverts back to the old exemption pre-TCJA Trump tax reform exemption of 5 million per person. So that tells us one thing. There's really two takeaways on this slide I want to get through. One is the exemptions are really, really high right now. Everyone has a lot of tokens right now. And it's important because you can use those tokens to transfer assets, transfer wealth to the next generation, transfer tax-free. And the other takeaway is, if you stay within those exemptions, the other takeaway is that this is not forever. These exemptions are only going to last for a limited period of time. And so we're educating a lot of clients right now and having a lot of good discussions about how to effectively leverage that exemption and when is the right time to do it. And this is really a team discussion. It takes into account not only estate planning lawyers like me and Laurie, but financial advisors, the accountants, valuation advisors, insurance professionals. It really is a kind of a holistic discussion with the advisor team on what makes sense and when. And we are certainly not encouraging, our clients to give away everything they own or to lock up everything they own. But, there are effective ways to transfer portions or to do it strategically over time so that these exemptions or tokens are leveraged as much as possible before they go away. I will also mention, as part of the second takeaway, that the exemptions are set to expire, as we see here, at the end of 2025, but there are at least a dozen bills floating through Congress right now that are looking to reduce the exemption or tokens down to 3.5 million. And these are proposals that some might have some teeth. I think there's a lot of uncertainty in how the next few years will go in the political climate and with both the House and the Senate. But these types of bills we're starting to see more of, and depending on the administration, there could be some teeth to them. And if I think the big thing is, if clients are losing out on opportunities to shift using higher exemptions and they don't get on that train, and then we have a change in the law that reduces the exemption or tokens down to 3.5 million, I think that's a significant lost opportunity. So we're looking at these rules as a foundation and then building the discussion around those rules. So, Laurie, I want to transfer it back to you so that we can educate our audience about the applicable federal rates and how those will tie into all of this.
Thanks, Raj. So, as we mentioned, we are at dramatically historically low interest rates. And where that matters especially is if you're doing loans, intra-family loans or loans in between related entities. So the IRS says that you have to charge a minimum interest rate for private loans between family members, trusts, and related entities. And if you don't, that's going to be imputed to you as income, or it's going to be treated as a gift to the person you made the low interest rate loan to, or it might result in an original issue discount. Next slide. So when we say historically low interest rates, you'll see here that the IRS produces these interest rate tables every month. And I just looked up the June rates, and the May rate was 0.25 for a loan of up to 3 years. So if I wanted to give a loan to a family member and I wanted to charge them the minimum amount that the IRS would allow me to charge, last month, if I had started that loan, I could charge them as little as 0.25%. And the IRS would say, that's fine, that's not a gift, that is a legitimate interest rate for you to use. For a loan between 3 and 9 years, last month for May, the minimum rate was 0.58%. Again, just incredibly low. And for a loan over 9 years, so I could loan my son a lot of money, whether he wanted to start a business or if he wanted to do something, if he wanted to buy out my business, I could loan him that at the incredibly low interest rate of 1.15%. Well, this morning I looked up the June rate. The June rate, the short-term rate for loans up to 3 years, 18 basis points, almost free. So if I wanted to make a loan, almost free for 0 to 3 years, 18 basis points. Up to 3 to 9 years, 43 basis points. And a loan over 9 years, 1.1%. That is incredibly low. Next slide. So there's another rate that applies to any time that we're using annuities, life estate, so an interest for my lifetime, an interest for a term of years, or an interest that has a remainder or a reversionary interest. And so that's called the 75/20 rate. The May 75/20 rate was 80 basis points, 0.8%. The June rate is 0.6%, 60 basis points. So these rates are so low that they may allow us to do some very significant, very highly leveraged planning. Raj, you want to talk about the impact of depressed asset values?
Thanks, Laurie. And just to maybe foreshadow a little bit on some of the deeper discussions we're going to have later in this presentation, the Laurie was talking about AFR rates and 75/20 rates, and those can sometimes be confusing on how they're different and how they're applied in estate planning transactions and trust vehicles. And we're going to get into some examples of how they're used. But, one other point I'll make on the AFR rates and family loans that Laurie was mentioning is these rates not only apply to brand new loans. So Laurie will get into a little bit more about how the AFR rates and how loans can be structured, but they can also apply to existing loans if these existing loans are renegotiated or amended. And I think that can be a valuable tool because it will give us a second look at some of these existing financing relationships in play. So more on that later. Let's talk about depressed asset values for a moment. And again, we're really, Laurie and I are really trying to get through some of the core or foundational concepts and rules that we look at with the advisor team when we're analyzing an estate planning transaction. And in addition to taxes and interest rates, we also look at asset values. We know that the easiest asset to value is cash. If you have $100 that you want to transfer to a family member or transfer into a trust for the benefit of that family member, we know our value is going to be $100. You start to get into some unique valuation issues if that $100 was held, for example, inside an entity like an LLC or a partnership. It may not be worth $100 at that point. Then you look at marketable securities. Again, we have a pretty readily available value when we look at the market, because these types of securities, publicly traded, even thinly traded securities, have a ready value on the market, on the listed exchange. And so $100 worth of, I won't use airline stock, that might be a bad example, of GE, for example, or Microsoft, we know what that is worth. But if you start to change the nature of that asset, and that the marketable securities are held inside an entity, for example, that could change the value somewhat. Closely held business interests. Again, the value is going to be available once a valuation of the business is done. It may not be readily available like marketable securities, but a valuation is there to assess the value. And I think the key takeaway on this slide and what we look at as planners is we're in a market right now that is not only depressed, but there is a lot of uncertainty as to when the economy will return. And I know there are different opinions on that, but when you look at economies like this in the past, where the markets are down, unemployment is up, and there are several other factors that, tie into a depressed market, that naturally is going to affect the valuation of these types of assets. And particularly with a private company or a closely held interest, factors such as market liquidity and size and performance, asset values, holding periods, volatility, these are all issues that are part and parcel of valuing private companies and closely held entities. And what we'll see is that in this market, to Laurie's point, kind of making lemonade out of lemons, with depressed values, that creates an opportunity to shift interests in these types of entities, in trusts, to family members, to next generation, giving that opportunity perhaps for someone coming into the business an opportunity to buy at a lower value. So there are opportunities here, and that's really the theme that we're seeing given the market we are experiencing right now under the pandemic. Next slide, please. So I think we talked a little bit about how estate planners like me and Laurie and the rest of the advisor team are looking to leverage these exemptions or tokens that we're given. And the takeaway is, if we have an asset that might be worth $100 in a good market, but right now it's worth $70 because the market's down 30%, well, we would look to transfer that asset at a $70 value, so that in the future, if the market comes back, and more so, then that asset is no longer in our client's hands and in our client's taxable estate. It has been shifted properly, it's been protected, and the rebound of the value of that asset, along with any future appreciation, is going to be in the hands of the recipient. And that is really, I think, good and effective estate planning, getting the most bang for your buck using the exemptions that we have, and doing it within a time frame where we still have these exemptions to do it. Next slide, please. So I want to maybe just I have the exciting part of introducing more of the focus topics we're going to cover today. And Laurie and I will go back and forth a little bit and just try and spread some of these out. But I think there are really 5 or 6 key vehicles or techniques that we're going to dive into. And these are all taking into account some of the foundational rules that we have just gone through: tax efficiency, market values, interest rates. So we will be getting into some strategies with family gifts and loans. We're going to be talking about trusts, but specific types of trusts that have different rules associated with them on how they're taxed. Grantor trusts being one of them. And then getting more into those 75-20 rate types of trusts that Laurie mentioned. Grantor retained annuity trusts, also known as GRATs. Charitable lead trusts, known as CLTs. These are 75-20 statutory specific types of trusts. And then a few other types of flavors of grantor trusts, one being spousal lifetime access trusts, and then grantor trusts that can be a participant in a sale as a buyer. So very effective estate planning transaction. Next slide, please. So Laurie, why don't you take us into family gifts and loans?
Sure. So family gifts are giving away assets. So some of us are making family gifts right now simply because we're helping support our loved ones or providing for folks who have lost their jobs, or maybe even making loans to family members who have family businesses, so if we have liquidity. But most family gifts are under our transfer tax system. So in our transfer tax system, everybody probably remembers that you can give away up to $15,000 per person per year in present interest gifts. And that has no gift tax consequences. There's no tax consequences to the person who's making the gift, no gift tax consequences to the person who's receiving the gift. You can actually give more than that. So as Raj mentioned, there's these high exemption amounts, currently the 11 million plus exemption amount. So you could give much more than that. You could give $500,000 to your loved one, but you would be using up some of your lifetime exemption. So as we think about how do you leverage these exemptions, if you're giving away assets that have a depressed value, remember that the value, the amount of the exemption that you're using up is based on the value of the asset you're giving away. So if you're making a direct gift, if you're making a gift in trust to children or grandchildren, the transfer tax is based on the value of gifted assets at the time of the gift. And if you give away an asset that has a depressed value now, all future appreciation is excluded from your estate. So if I have even marketable securities, if I have securities that have dropped in value by 25%, and I gift them to my kids or my grandkids or to a trust for the benefit of my kids or my grandkids, and 18 months from now they have recovered that value, my gift was valued based on today's depressed amounts, not on that future amount that they're going to be worth 18 months from now. And so that future appreciation, that 25% jump up in value that we think is going to happen in the next 18 months, all of that is now outside my estate, and the IRS will not be able to impose a transfer tax on that. So that's a great way to get a bang for your buck. Similarly, if you have family business assets or real estate, again, things that have really taken a hit, that have gone down in value because of this depressed market, If you give those away today, subject to their value today, all that future appreciation happens in the hands of another generation and not in your estate, subject to transfer tax at your death. So that can be a real advantage to people. Next slide. The other thing, as Raj kind of foreshadowed earlier, is if you want to make loans to your loved ones or to other family entities or family trusts, you can use these AFR rates. And so there's some advantages to that. One is you can keep those interest payments in the family instead of paying them to a financial institution. You can allow the borrower to try to beat the AFR rate by capturing commercial interest in return. So you can try to get kind of an arbitrage between I lend money to my son at 0.18% for 3 years. He goes out and invests it and in 3 years makes 10%. He still only pays me back the 18%, and he gets to keep that difference between what he has to pay me back and what he made by capturing that commercial interest in return. And again, that happens outside my taxable estate. So when we're doing intra-family loans, we have to be careful because the IRS is always going to be suspicious that this is really a gift, that this isn't really a loan, this is really just a gift. So how do you avoid the IRS saying that a loan to a family member or to a family entity or between family entities is actually a loan and not a disguised gift? Well, you have to think about having arm's length terms. So it has to look like a real loan. So you have to provide it for at least an AFR, the applicable federal rate interest, depending on the length of the loan. You should have a written loan document. And even though, again, it's intra-family, everything's on a handshake, or at least that's how a lot of people like to think about it, you really do need to make formal payments, including the interest, ideally including some amortized principal, although if you have other factors like security, that might not be necessary. You want it to look like a real loan, like a loan between strangers other than this extremely favorable interest rate. So a lot of people already have outstanding family loans, either with family entities, with family trusts, or even with family members. If you've got a loan with a family member that you've lent them money to buy a house or to do something else, take a look at those loans. It may be time to renegotiate those and to reduce that interest rate. That can have a dramatic effect on people's future ability to pay back those loans. If people aren't able to pay back loans because of their economic circumstances and you do have intra-family loans, again, think about renegotiating those, turning those maybe into an interest-only loan that is at the new AFR rate. Those are some things that you can do now, either in a very sophisticated setting between family trusts and family entities, or in a very informal setting where you've lent money to a family member either just to help them out or for them to do their own investments in real estate or a business, or even just to pay back things like student loans. Raj, you want to talk about the Grantor trust rules and how that can have some help on the leveraging side?
Thank you. And we're probably at our midway point in this webinar, and so we really do want to get through the next 15 slides or so before our time is up. So just continuing on, this is the next type of planning technique that we would look at to kind of leverage exemptions, leverage and utilize those low interest rates that Laurie was talking about. And the vehicle we typically recommend as one of the options is what is known as a grantor trust. There are many different names that this type of trust has, but we'll use for purposes of this presentation grantor trust. And it's a grantor trust, just to oversimplify it for our purposes, is an irrevocable trust. There are revocable living trusts that, many many people have as part of their basic foundational estate plan. And revocable living trusts are also grantor trusts because of their provisions and their tax features. But for our purposes, when we're looking at shifting assets into a trust for protection and to leverage exemptions and factor in the low AFR rates, we're talking about an irrevocable grantor trust. And a grantor trust really means that the trust has certain features, powers, or provisions in it where under the tax rules that apply to grantor trusts, the creator of the trust, with some exceptions, is treated as the owner for income tax purposes. So this, I think, can be illustrated with an example. If I create an irrevocable trust and I am the contributor to the trust and I seed the trust with a certain amount of value, let's say in marketable securities, a little bit of cash, and a closely held company or a portion of that company I'm trying to pass down to my children. As long as the trust has certain features that it's going to make the trust an income tax owner as to me, so that every year when the trust earns income, ideally, through interest, dividends paid on marketable securities, and distributions attracted from the private company stock that it owns, the value of those distributions and income and dividends are going to stay inside that trust and grow. But the income tax liability on those on that income is going to be my responsibility as the grantor because of the provisions in that trust. And the question is, for those who are just learning about grantor trusts or who are a little fuzzy on the rules, the question we usually get is, why would I do that? Why would I want to pay the income tax if I'm going to set up a trust like this? And there are a couple key reasons. One is by having the trust be styled as a grantor trust, the creator is maintaining certain flexibility and powers to do business with that trust. We're not going to get into those details in this presentation, but the key is flexibility. It leaves the door open to transfer assets in and out, borrow from the trust, have certain types of transactions and flexibility with that trust. Number two is that by paying the income tax, by me paying the income tax on this new, hip, fresh grantor trust that I created, that everybody's telling me to create, what I'm doing is I'm preserving value for my children and future generations, because that trust is not responsible for paying the tax. I am. And so I am paying money out of my pocket to preserve value in that trust. And that's a benefit because for planning purposes, that's a good thing to do. That's the goal, is to shift to the next generation. But from a tax perspective, it's very powerful, because if I am benefiting this grantor trust with the value of income tax liability every year, let's say my tax bill is $50,000. Well, I'm effectively making a gift of $50,000 to the beneficiaries of that trust, but the tax rules don't treat it as a gift, so it's a freebie. So instead of just transferring $50,000 of cash into that trust to pay the tax liability and call it a gift, by being responsible for that tax liability up front, there is no gift, and the tax authority is settled on that. So that's a really powerful planning tool and technique when using a grantor trust. Next slide, please. So what are the advantages? We talked about some of them. A few other nuanced advantages are with S corporations for clients who are trying to shift shares of an S corporation into a trust. There are limited options because the S corporation rules only allow certain eligible shareholders. Otherwise, the S election of the corporation can be jeopardized. And so a grantor trust is on that list, that short list of eligible S corporation shareholders. Other benefits we'll get into in a moment, but again, these all tie into the features of the grantor trust. And from a tax perspective, if I'm paying the tax on the grantor trust as opposed to the trust itself, there might be lower tax liability because, as a general rule, individual tax rates will be lower than trust income tax rates after a certain time period. And this is because trust income tax brackets, you reach the highest tax rate very quickly. That number is adjusted every year for inflation, but it's around, I think, $12,000. So the 37% tax rate only with $12,000 of income, whereas for individuals, you are in the hundreds of thousands of dollars before you even reach the top tax rate of 37%. So that's just another, I think, play on the rules. Next slide, please. So a couple more takeaways. We talked about how these trusts have to be irrevocable, and that's because they allow a transfer to be treated as a gift. So as Laurie was mentioning, if we want to use these gift tax exemptions that are very high right now, if we want to use annual exclusion gift allotments, which we mentioned earlier was $15,000 per year per donee, then the trust has to be irrevocable because we need the transfer to be a completed gift. We also like the fact that having an irrevocable trust and allowing the transfer to be a completed gift means that once the asset is sitting inside that trust, well, ideally it will grow over time, and that appreciation of the asset is not in my estate as the transferor, but it's in the estate of the trust itself. And what that means is, depending on how the trust is set up and how long it lasts, it may never be subject to estate tax. It may never have to go through the IRS checkout lane and be assessed a death tax or a transfer tax. So that's a pretty powerful rule that will apply. Next slide, please. We talked a little bit about, just briefly, the advantage of paying the income tax on behalf of the trust. So I transfer an asset to the trust. I'm paying the income tax, allowing the value of the trust to be preserved and grow. And I get a tax-free gift by paying that bill every year. The psychology of that can be difficult. And, it first starts with the question, why would I do that? Sometimes, even after explaining the rules and the benefits, it still may not, it still may be unsettling. So, there are strategies to allay the cash strain on the transferor. If I ever have a year where I'm paying income tax on this trust, and in a particular year it's high, or my cash availability is low, I'm in a pandemic right now where I'm preserving cash or trying to preserve cash, and this tax bill is just something I don't want to have to deal with this year. Well, these are all situations that happen, and there are strategies to allay that income tax burden. And a couple we've listed here are just different features in the trust itself. Perhaps making the spouse a lifetime beneficiary of the grantor trust, so that In the event the household needs assets, the trust can distribute to the spouse, and then that circle is completed so that in a particular year or a certain time, under the circumstance, that household has access to funds to pay income tax. There are certain types of fiduciaries outside a trustee that can be appointed in a trust like this, who have the ability to maybe amend the trust or to deal with tax situations, perhaps reimburse the contributor, the creator of the trust, for income taxes in a particular year. These are state-specific and federal rules, and fortunately in Michigan, we have the state law that allows us to have these types of reimbursement provisions. And then you can have other features and powers in the trust where, the creator may say, look, I've been paying the tax on this trust for so many years, but I'm kind of tired of doing it, and what I will do is I want to turn that feature off. And there are the abilities to do that in the trust itself. Next slide, please. So, continuing with our menu of options and planning techniques, one of the types of trusts that we mentioned earlier that takes advantage of this historically low 75-20 rate is what's known as a Grantor retained annuity trust. And Laurie, I don't want to steal your thunder, but why don't I kick it back to you and please tell us a little bit about GRATs and how they can be effective.
So the way that I describe GRATs is you give all your money to a trust, you get all of your money back or almost all of your money back plus the statutory interest rate, the 75-20 rate. So the IRS says, well, you've made a very small gift or almost no gift, and so it's a low risk strategy. So the idea of a GRAT is you are transferring any appreciation above and beyond that 75-20 rate. So if I put assets in this trust and they appreciate in value more than right now 0.6%, then anything above and beyond that, I can pass that on to my kids without any transfer tax consequences whatsoever, or extremely small transfer tax consequences. So the idea is that I'm making a gift to my kids, but that gift is any appreciation above and beyond that hurdle rate, that 0.6%, that 75-20 rate. I'm making that remainder gift to my kids. But because I get all my money back plus my interest rate, the IRS says the gift tax that I have to use I love Raj's, the IRS checkout lane. So when I go through the IRS checkout lane, I'm telling the IRS, here's all my groceries. If it turns out that this raspberry plant that I buy produces 50 tons of raspberries, so what? All I have to pay for in the checkout lane is the raspberry bush, which isn't worth much of anything. So it's a fantastic way to leverage gift tax. Let's bump to the next slide. This is a statutory, so the IRS actually has written rules. Like, it isn't smart planners making this stuff up based on IRS regulations. This is actually right out of the law book. So it's a very low risk strategy. Another great thing about the Grantor Retained Annuity Trust is that, let's say that my raspberry bush is doing great and I really like raspberries. I can swap out assets inside the GRAT for a different kind of asset. So let's say I put my an interest in my business into the GRAT, and it's doing really well, and I do want to pull that back. I could, so let's say I put it in, it was worth $100, and I get my $100 plus my interest rate back, plus I can take that amount, and so now it's worth, a year later, let's say it's worth $150. I could take $150 of cash, put that into the GRAT, because that's now what that asset is worth, and take that asset back so that I can have everything else related to it in the future, that $50 of growth still goes off to my family without any transfer tax consequences. Bump to the next slide. So payments can be weighted towards the end of the term. So again, what you don't want is I put my depressed asset in today, and now, again, I'm getting all my money back over time with that 75/20 rate, but I don't want to take it next month or maybe even by the end of this year because my asset value is still depressed. You can weight the payments towards the end of the term. There's some limits on that to maximize the growth opportunities inside the GRAT. What if the assets underperform? Well, and what if it just doesn't work? Again, there's very low risk because you've only used a very small amount of your gift tax exemption. And so if the assets don't perform, which again, we never know for sure, but they can be returned. So let's say I put my $100 in, and instead of going up in value, they go down in value. Well, the trustee can just give those back to me in satisfaction of that rule that I get essentially all my assets back plus that hurdle rate. So it's a very low risk strategy. And right now, even if you do it with something like marketable securities that have gone down in value, could be a home run in terms of pushing future appreciation into the hands of your children without using almost anything at that IRS checkout lane. You've used very little of your gift tax exemption. Next slide. So why doesn't everybody do this? Because it is such an easy way to push appreciation out of your estate. There are a few disadvantages, but again, they're really not very significant. So the GRAT trustee has to actually maintain books and records, make the payments on time, file tax returns, and again, they're just reporting returns because it's a grantor trust, but it has to actually be operated as a separate entity. You do have to file a gift tax return at the time you create the GRAT. And if you want to make gifts to your grandkids, you can't allocate generation skipping tax exemption until the end of the GRAT term. So it's not a great way to make gifts to your grandchildren, but it's a fantastic way to make gifts to your children. Again, particularly gifts of fast appreciating assets. Another potential disadvantage is when you make a gift, whatever the basis of that gift is, your beneficiary that gets a carryover basis. So there's not a step up in basis when those appreciated assets pass on to your beneficiary. Another disadvantage is if the grantor, the person who creates the GRAT, dies before the end of the term, the assets generally get pulled back into your estate. And so if you die before the end of the term, this doesn't work. So what we do is we try to guess at how long you're going to live, and we try to pick a GRAT term that's going to be well within your life expectancy. Next slide. So an example would be Mary has marketable securities that have declined in value but are likely to appreciate. I'm using a very simplified example. So Mary creates a GRAT with a 4-year term and gifts her $1 million in marketable securities. She chooses to get 25% back each year, so she's going to get all her money back, plus her 75/20 rate of 8%, now 6%. So when you do the calculations, you might actually do 24.999 that she would get back each year, so that she reports a tiny gift. So even with a very modest 6% annual growth rate, now her remainder interest is worth $168,822 in 4 years, and she's only used $19,000 of exemption to transfer $168,000. Imagine if you add a zero. Imagine if she did that with $10,000 or $10 million in marketable securities. Now she's transitioned $1.6 million. So this is a very strong leveraging tool. Next slide. So just some comments. So that was an exceedingly simplified example. So more likely than not, what we would do is we would be contributing a minority interest in a business entity or an LLC, or we'd even wrap those marketable securities into an LLC. And when we got an appraisal, we would find that there would be discounts for lack of marketability, lack of control, and so we'd get a discount above and beyond all the leveraging that we're getting from this GRAT tool. If it's an entity or securities that are actually making income distributions in addition to growth, liquid assets can be used to satisfy the annuity payments, and that would allow the business interest to continue to grow. As mentioned earlier, if Mary wanted to acquire whatever she had put into the trust, if she wanted to take it back, she can exercise her right to substitute or swap her interests at fair market value. One of the things that we'll often do with a GRAT is because none of us knows which asset class is going to do great and which are going to completely fail. So we would typically set up separate GRATs for separate asset classes so that the ones that hit a home run pushed all that future appreciation into the hands of the kids. The ones that didn't perform, that failed, Mary would get all her money back without much gift tax cost, but it doesn't then, it doesn't drag on the performance of those highly performing GRATs. So once the GRAT terminates, Mary can actually re-GRAT. So as she gets her 25% per year, she could take that and put it into a new GRAT to continue to shift future appreciation in excess of that 75-20 rate. Again, that 0.6%. So over time, we're almost certain that most asset classes are going to be able to beat that hurdle rate. And we do think that right now, GRATs are just a fantastic way for higher net worth people to shift their future appreciation into the hands of their loved ones and out of their taxable estate. Raj, do you want to talk about sales to intentionally defective grantor trust?
Sure. Thanks, Laurie. There's so many acronyms this morning. This is like alphabet soup, and there's only a few more we're going to cover. We've got about 7 minutes left, so we really want to touch on, I think, two more key vehicles. If we can go to the next slide, please. This is really continuing on with a type of strategy that, continuing on with the theme that of the strategy that Laurie was talking about with the GRAT. This is another type of transaction where we're shifting assets, whether it be depressed marketable securities or private or closely held stock, into a special type of trust and getting tax advantages out of the transfer. A sale to a grantor trust is using that foundational trust we talked about earlier, the grantor trust, an irrevocable grantor trust, and essentially selling the asset to that trust, capturing a depressed value now with the goal or expectation that the value will recover in the future. You typically see these types of transactions in good markets prior to a sale event for a company. For example, if before perhaps a company is going to market, or there is any affirmation that the company is going to be sold, that's when the due diligence is started. That's when discussions are had about perhaps doing some planning with the entity prior to the sale, so that post-sale any appreciation in sale price can be captured inside this type of trust. And the technique works equally as well in markets like this, where we have depressed values. Even if there is no anticipation of a sale right now, we have 20 to 30, perhaps even greater of a percent discount right now that we're seeing, where these assets can be transferred into the trust, and then as the market recovers, the trust and the beneficiaries benefiting. So instead of a straight gift, this technique involves a sale. And without getting into too much detail, I think the oversimplified way to explain this is it's the creator of the trust selling the asset into the trust, to the trust, where the trust is the buyer or the purchaser. And these are done on arm's length terms. There's typically financing, not through third parties or commercial financing, but seller financing, where the trust is going to give a promissory note with a down payment to the seller being the client selling the assets to the trust. And as Laurie mentioned earlier, an added benefit of this is we have low AFR rates. So that's typically the rate you're going to use to affix to the promissory note. And so this financing might be done at 0.6%, depending on the term of the note, which is almost the same as cash. So there's very little appreciation happening to the seller. The seller has not had to have used any of the lifetime exemption we talked about, these tokens, because it is a sale instead of a gift. And we hope the transaction works if the asset is planned to appreciate. So those are really the nuts and bolts of a sale to a trust transaction. We're seeing a lot of these types of transactions right now. We're working with a lot of various professionals, just having some very interesting discussions with valuation firms. There are studies that are put out by national firms. I think a really good one that I would point everyone to is a recent one done by Management Planning Inc. Very thorough analysis on how the market is affecting valuations right now for private companies. And so there's a lot of thought that goes into timing and valuation. Next slide, please. This is just a style of a grantor trust. So we talked about the concept of selling to a grantor trust, and what might be utilized here is a sale to a grantor trust where the spouse is the lifetime beneficiary. And we briefly talked about that earlier, how you can style these grantor trusts for flexibility where the spouse is a lifetime beneficiary that provides household access to cash or distributions. And even if there's not a sale transaction, if there's a straight gift or a partial gift and a partial sale, the style of the grantor trust is important. And having the spouse be the lifetime beneficiary really adds a lot of flexibility to the transaction, not only because we have the ability to get money back to the household through the spouse as the beneficiary, but it provides flexibility on timing. For estate planning purposes, it really delays any benefit to children or G3 because there is typically no entitlement to trust assets until the until the spouse has passed. So that really is a nice feature for families who really don't want to benefit G2 or G3 right away, and they want to time it so that this all takes place, after the lifetimes of the spouses. Let's finish up with just a few minutes on charitable lead trusts. Next slide, please. We might have to go a few slides ahead. There we go. So we've done several webinars on charitable planning in this environment. So I don't want to reinvent the wheel and go over what we've already covered in prior presentations, but we haven't really talked much about the types of trusts, the charitable trusts that are being utilized in these types of low interest and depressed market environments. One is called a charitable lead trust, and the reason we're mentioning it today is because the charitable lead trust, unlike a charitable remainder trust, which we talked about in a previous webinar, really revolves around the 75-20 rate that Laurie mentioned earlier. And the 75-20 rate is the rate that has to be applied to calculate the gift interest in this trust and the charitable interest in this trust. And this slide really lays out the nuts and bolts of a CLT. It's an irrevocable trust that provides an income stream right away to a qualified charitable organization. So you typically see community foundations, public charities, those types of institutions that will be the beneficiary of this type of trust. And the term interest or the lead interest is for a certain duration set by the terms of the trust. And then after that duration, the balance, whatever's left in the trust, is distributed to non-charitable beneficiaries. So typically these are family members. These types of trusts come in a variety of flavors that offer different financial and tax benefits. And so a lot of the analysis on what type of charitable lead trust, one example is, should it be a grantor trust like we talked about earlier, or should it be a non-grantor trust? You know, those types of decisions, the modeling of what the charitable lead interest should be, value, and so forth, that's really done up front, obviously before the trust is executed. And I think what's important is, you know, as it relates to the 75/20 rate, they're effective right now because that 75/20 rate is so low. As Laurie mentioned, 0.6%, I think, is what we're seeing for June. And when you fund a charitable lead trust, essentially there is a taxable gift that's equal to the initial value of what's contributed to that charitable lead trust minus the value of all charitable interests. And to calculate that charitable interest, it really is a math problem. It's equal to the total payments that the charity would receive over the trust term, but then that value is discounted to present value using that 75/20 rate Laurie was talking about. And that's a fairly conservative interest rate, you know, set monthly by the service. And again, just to reiterate, we are seeing historically low 75/20 rates. So the bottom line is, if the trust assets outperform that 75/20 rate, which seems fairly easy to do, then that charitable trust will produce transfer tax benefits because of the appreciation and growth that goes to the non-family members after the charitable lead interest is paid out. So let's go to the next slide. And I think really we just go into some of the mechanics of how those calculations are done that I just ran through. And I think we can flip to the next slide. I think it had maybe a few more points here. No, I think we covered this. Next slide, please. Yeah, just a couple takeaways. These types of trusts, there's a lot of mechanics involved in not only the due diligence up front and calculations, but if we're contributing anything other than cash or, you know, securities that have a ready value on a publicly traded market, we're going to need a valuation. And again, this is a time for opportunity, because if we're shifting interests of private companies or hard to value assets, debt instruments, for example, we're going to need a professional valuation that's done as required under the tax rules. And it's also presenting an opportunity to transfer assets at a depressed value using these valuation discounts we referred to earlier. I will say, this is not on the slide, but I think a common trap that we see with less experienced practitioners is using certain types of charitable trusts to own S corporation interests, private stock, closely held interests that are of S corporations. And again, we have to kind of go back to that eligible list of S corporation shareholders. Charitable remainder trusts, for example, are not eligible as shareholders. Charitable lead trusts can be, but they have to be a certain type of charitable lead trust. So again, this is just part and parcel of the analysis that's done up front before these types of trusts are put together. Next slide, please. So Laurie is the chair of our group. I know we went a few minutes over, but I'll kick it back to her to, you know, just conclude with some closing comments. Thank you.
Sure. Well, our point here is that we're in a very unique time, and because of that, if the purpose of estate planning is leveraging the estate tax, gift tax, and generation skipping tax exemption, now is the time to do it, where you can get a lot of bang for your buck. You can get a lot of easy pushes of appreciation into future generations without very much risk and with some pretty simply executed techniques. So now is the time to revisit your family's wealth plan. And even though things are hard now, assets are depressed now, we really are optimistic that things will return and that the new normal after this difficult time will be a time when we will see appreciation, where people will again be concerned about getting their family businesses transitioned to loved ones. And we do think that now is a time to take a look at your plan, see if there's some things that you may want to think about doing, and using these bad things as potential positives for your future estate planning. We hope everyone is staying safe, staying well, staying sane. We want you to know that we're here with you and we're happy to answer any questions you may have. We appreciate your time and attention today. Feel free to email us or contact us with additional questions. Thank you so much and best wishes to everybody.